All right. Hey, good morning, and thank you for joining. I'm sure people will be calling in. I apologize. I started this just a little bit later than I normally do. If you have questions, use the chat function or try to text me, and I'll do my best to read it and get those questions answered. So let's start taking a look at what all's going on in this market. Fundamentally, nothing has changed from last week. And I'm just going to go ahead and summarize the fundamentals. They're bullish. The acreage number was bullish. The South American weather is bullish. Yes, we have great planting weather, but the ocean temperatures and the threat of La Nina are bullish factors. And when you look at the supply and demand tables, the conclusion is we have pressure to yield a huge crop, or we're going to continue to have a shortage, right? So I want to the fundamentals lean bullish. On the flip side, the bears are arguing what ifs, right? They're saying, well, what if we get in a conflict with China? What if ASF is real in China and they don't need any food? What if all those things happen? And I mean, it doesn't take a rocket scientist to recognize that if China doesn't buy any of our food and doesn't import, then we're probably overvalued, right? But that's not what's happened. That's not what the market's telling us, and that's not what they're doing. So the thought that that's just gonna all of a sudden pop this balloon that we're in and we're gonna crash back down, I really think that, I mean, I don't want to take that bet because everything else lines up just too bullish. So what we're going to do today is kind of take we're gonna try to really simplify what these charts are telling us, because for the last 90 days, sitting in front of you is the May corn chart. Here's January 19th. Since then, we've been sideways, right? We've been sideways, and we've popped a couple times, and it got our hopes up that we were gonna, rally on up to $6, and then somebody comes in and just smacks it, right, and sells off. And so these sell-offs that are happening every day from 8:30 to it seems like just forever. These sell-offs that are happening feel a lot worse than they really are. And so when we look at a chart, we're not trying to say the market's right or wrong, right? When we look at a chart, our first job is to try to identify what the trend of the market is. We're trying to identify that trend because we know that trends tend to persist. There's a saying, the trend is your friend, right? The trend is your friend until the end when it bends. And that's a very, very true statement. And so I want to kind of go through what we look at to identify what the trend is, because anytime the market consolidates and moves sideways, the tendency is for people to become very fearful and assume that a trend reversal or a trend change is going to happen. And days like yesterday make it feel that way, right? Because we were up 7-8 points, and then all of a sudden somebody turned on their selling algorithm and they just sold it like crazy, and they sold about every 5 minutes. They just sold a huge lot, and the market just came on down. So but if you look at it, we traced an inside day yesterday. The peak of yesterday and the low of yesterday were inside the prior days. So it was an irrelevant day technically, completely meaningless. It just didn't feel very good because it felt like we were collapsing. So when we're looking at a trend, the first thing that I look for in any trend analysis is, where are we in relation to this cloud, right? We're above it. Period. End of story. Our bias is higher because we're above this cloud. Just that makes things so much simpler. Where are we in relationship to where we were 26 days ago? We're above where we were 26 days ago. Our bias is bullish, technically. Now, another thing I want to point out is, let's look at this 560 level. I'm going to put my cursor right on it. We have traded above 560 exactly 6 days on this May contract. We've closed above 560 twice. We closed above 560 here, which was the report day, and this was the February report day, was the last time we closed above 560. Then each day after that, right, we bounced up and we reversed. There's lots of people that are focused on these reversal days right afterwards, and it is true, they did reverse, and yes, that is resistance now. But what's important is look at the grind higher. Even in this sideways trade, as we've worked ourselves kind of into this frenzy and panic of, oh my gosh, the trend is going away, we've done no damage technically. And when markets consolidate, the trend indicators tend to just come into neutral. So now I'm going to jump down to this lower indicator down here, right? This is the MACD. It's called Moving Average Convergence Divergence. It's a very widely used indicator. And here's the gist. When the market is trending, it tends to grow a histogram like this, and it pushes itself up. When it consolidates, the histograms get real small to where you really can't see it. And what follows consolidation is generally a trend. So now the big question is, which direction is it going to go? Well, our main system is telling us we're working higher because we're above our cloud. We're above where we were 26 days ago, and the general thrust has been higher. After each one of these breaks, just follow the closes. And I can't draw a line on the closes, but they're trending higher. Everything in here is actually working to the upside, even though it feels like we're getting smacked every day. Now, there's another indicator that I got to switch over to Thinkorswim so you can see it. But this indicator actually does a nice job of forecasting trends, and I don't show this a lot, and honestly don't look at it very often. But it's useful in this type of situation. It's this indicator down here called the DMI, the Directional Movement Index. And I'll just give you a kind of an example of what it does. So you've got this blue line right here. This represents some bullish bias. It's calculated using closing prices and highs and lows. So if the highs are getting higher and the lows are getting higher and the closing prices are getting up, then the blue line overtakes the white line, and if lows are getting lower and closes are getting lower, then the white line overtakes the blue line. Okay, so you have a bullish line and a bearish line. But what identifies a trend here is this red line, and when it starts to curve and work its way higher, that's usually the beginning of a trend. So you can see this consolidation pattern that we had back here in November. We can see the DMI break above the bulls retook the market, and a few days later the movement index started to creep higher, and that was the beginning of this bull trend. Now this is also when we came up out of our clouds. I mean, there's lots of corresponding things. And so when you're trying to identify the direction of a trend or the most likely and most probable move that might happen next, you want to look at different trend indicators to get an idea of their alignment, right? And when they line up, it's powerful. And so look what we've had here in the last few days. Okay, back up. When the market starts to correct, this line starts to work its way down, okay? So when it's trending up, it means it's an uptrend. This just means it's a correction. So this entire move sideways has been a correction, and you would usually expect lower prices. But look at the tilt of this market. It's been up the whole time. Now we're starting to tick back up on this directional movement index, which could be the beginning of a new trend. So we've got all of our trend indicators lined up and identifying that the next most probable move is higher, not lower. And I think this 560 level, if we can get a good close or two above 560, I think that identifies where it's at. And so what's going to cause that? Well, number one, it could be the report coming out on Friday, right? the WASD is going to come out. They're not going to update acreage in that, but they might tweak demand, and they might actually come in and confess that they're, that they're light on their demand numbers, and that they actually have to start trimming the balance sheet to be reflective of that. This market is bullish. It's not bearish, and I would not want to be caught selling it. Now, what will change our mind here is if we break lower and start taking out these lows, right? So we've set ourselves up for a nice little 30-cent range. In my view, this is worth the risk, because what might come after here could be very significant, because it's the same setup we have as back here in November. Are the fundamentals there to support a move in equality to this? Absolutely. Without a record crop, we're in trouble on our supply and demand tables. All right, so that's corn. Nothing has changed our mind on corn whatsoever. We keep finding it supported. So let's take a look at beans next. Here is old crop beans. Really the same analysis, right? What's our trend? Where are we in relationship to where we've been? Well, we're above our cloud. We're bullishly biased. We have nothing to think that that we're going to work lower here. We're above where we were 26 days ago. Granted, not by much, but we're still above it. So therefore, our trend is bullish. Our MACD has come to equilibrium. It's come to neutrality, and we're getting ready and trying to cross back up to start building a bullish histogram. You can see what happens here, right? You get the cross and it starts to move. You get a cross and it starts to move higher. As we've worked sideways, we've come down to neutrality, and we're ready to rock and roll. Another thing that I was looking at is commitment of traders. The bean funds are in their smallest long position that they've had for the last 6 months. And yes, they're still long. Yes, they're still aggressively long, but they're in the smallest relative position, and their size limits have doubled. So they have the horsepower to come in here and rocket this thing higher as we get lower. Remember, the USDA's balance sheet that just came out on beans is negative 300 million bushels if we have 2019's yield of 47.5, and we're negative with an all-time record yield of 52. The beans are negative. That will not happen. The market will rectify that, because we're not going to go negative on it. But that balance sheet is so tight on beans. I read an article that said the South American tail is going to be so powerful that it's going to kill our demand market. That is complete nonsense. The South American crop has been known and digested in this market, and we're up at these levels even with a huge South American crop. And guess what? That crop's probably getting smaller, not bigger. A tail off of that market is not going to just change things radically here and catapult this market lower. We're set up too well. All right, let's look at new crops. So here's our November beans. Again, what's our trend telling us, right? We're above our cloud. We're way above where we were 26 days ago. In fact, this is even better because we're above the most recent highs, and this line is out in space, which is where it likes to be. Now, we've consolidated here into a little bit of a triangle. I think this is starting to look like a flag, and I think that's going to resolve itself to the upside. Again, beans have a negative balance sheet. They're not going to work themselves much lower. So what does the directional movement index say on beans? Let me pull that up real quick. Let's start with May. Look down here, same setup. You've got the bulls that have retaken the bears, and we're starting to tick higher on our move. When was the last time that happened? Right here, back in August. This is the same technical setup that we had in August on May soybeans. Can we propel higher? Absolutely, we can. The market has done a nice job of digesting. moving itself to neutrality, and the funds are in there, have plenty of horsepower to push it higher. Do the fundamentals support it? Absolutely. We have no room for error, and lower prices that encourage buying and demand make no sense in this type of situation. At what point are we wrong? Well, last week's low. We break that, something's off, and this analysis is completely wrong. But the only thing that will tell us that is price action, because if we're wrong and the fundamentals have shifted to where we're not tight and we don't need to ration and we don't need to buy acres, then I'm not aware of it, and I can't find anything in the market, in the literature anywhere, that would support that argument. I'm not saying it's not there or that it couldn't get there, but today I can't see it. So we're going to watch that low. I think it's prudent and worth the risk to let it work itself higher and resolve itself. All right, last thing that I want to talk about is December corn, because I think this will help put a little understanding about what is happening here. And this is pure theory on my part. I have nothing but nothing but kind of experience to back this up. I think that the corn market keeps getting smacked intraday because the algorithms hate this gap right here on December corn. So December corn gapped up from 477 up to 480. So we've got a 3-cent gap right here. And there's 3 types of gaps, but what a gap is, it's an incomplete story, and your brain can't handle it. So try to hum "Mary Had a Little Lamb" but don't finish it. In your mind, just try to hum it, but then stop before it's finished, and your brain won't let you. It will automatically finish it for you because it's called a story gap. And this is what a gap is in a market. It's a story gap. Gaps tend to get filled, and there's only 3 types of gaps. There's breakaway, there's continuation, and there's exhaustion gaps. And so, which one is it? Every corn market, every corn chart had a gap on this day. We filled them all with the exception of the new crop gaps. And so December corn's is in a tight spot. Number 1, we're trading against this gap. Number 2, we're broken all this support back here. So remember, if you break support and then fall back below it, it can be construed as bearish, right? But it's got this story gap, and the market wants to close that. You can feel it. It wants to resolve it's that song that quit playing in the middle of its rhythm. It wants to do that. If it does it, is it bearish? No, not at all. Actually, this is a really nice buy setup if it closes the gap and then works itself higher. It's a very, very traditional setup. So I don't know if it's gonna fill it or not. If it doesn't fill it and it works higher, then this could be a breakaway gap, or it could be a continuation gap, and that counts. I'll just give you the math. A continuation gap counts to about 640 on December corn, if that's where it's at. And I'm not saying that's where we're going. I'm not saying that's what's going to happen. But technically, if we take off up and out of here, then that's a target off that gap trade right there. So from my view, the trend is up. The trend is our friend. There's been no reason to think it's at the end or it's going to bend. That applies to both beans and corn. And I think wheat is going to absolutely explode if corn pops up and out of here. We're feeding it like crazy, and it's at the cheapest relative values to corn in history. So wheat is rationing corn for us, and that's going to create its own problems. So I'm incredibly bullish wheat, very bullish corn, very bullish beans, and I see nothing to change that. I promise you, we were paying attention all day, every day to anything that might change that view, and if that comes up, we will let you know. But I think that's our analysis as of Wednesday morning. I hope that's helpful. I hope it puts it in a little bit of context for you. As always, if you have questions, please call us. There is significant risk in trading futures and options. If you're going to trade them, make sure you do so in light of your own financial condition, and consult a professional before you do it. I hope you guys have a great Wednesday. We will talk to you soon.